So in a recent video, I gave you guys my top 5 favorite dividend aristocrats, which are stocks that have grown their dividends for over 25 years in a row. But in today's video, we're upping the ante with my top 5 dividend kings that have grown their dividends for over 50 years in a row. And the great thing about this market downturn here in 2025 is that as stock prices fall lower, their dividend yields will rise even higher, which by the way are already very high, as these stocks have also lost a lot of their value already this past year. So I can't wait to share this list with you. It's going to be a ton of fun. Some great dividend payers here to throw up on your watch list and keep an eye on. Hit that like button if you want more videos just like this. But let's go ahead and jump straight into it. Now, coming in at king number 1, I'm going with a stock that I also own myself in PepsiCo, ticker symbol PEP, which is also a global powerhouse in the food and beverage industry with some of the most iconic brands like Pepsi, Frito-Lay's, Doritos, Cheetos, Gatorade, Bubbly, Lipton, Quaker, and much more. And it's that diversified portfolio really across both snacks and beverages that not only makes them more appealing to me over their biggest rival in Coca-Cola, which primarily sells just drinks, but it also provides a little more resilience during market fluctuations too. Hence why the company has been able to grow their dividend for a whopping 53 years in a row. And after losing over a quarter of its value from the top recently, the stock is now yielding close to 4% on that dividend, which is not only among the highest levels it's ever been, but it's also close to double the sector's average of 1.8. Speaking of which, after the drop, PepsiCo's valuation is also around 20 to 30% lower than their own 5-year average now on a PE basis, while also trading at about the same level as the sector. That's very attractive for a market leader like this. Unfortunately, being such a large global player like PepsiCo, they will likely be affected by tariffs, as you would expect this year, which is a concern that investors should be aware of. However, that's much more of a short-term issue than anything else. And if you think our current escalating tariff situation is going to stay like this forever without any trade deals ever getting done in the future, I just think you're strongly mistaken. Tariffs will come down eventually, trade deals will get signed, and ultimately anyone who bought the dip on this world leader will, in my opinion, likely be awarded years from now when they get to, keep collecting these pretty high dividends on the stock while everyone else gets a much lower yield from buying the stock at the top at a higher price point. And even though I do think that there's a rise in more health conscious options these days, PepsiCo is so large and dominant at this point that they can easily just acquire smaller players whenever they pop up, as is evident with new product launches and acquisitions like they did in Bubbly, SodaStream, keto-friendly chips, Health Warrior supplements and snacks, and their newest edition of Poppy that they just acquired this year. Add it all up and PepsiCo is easily one of the best dividend king stocks available this year for a pretty nice discount. All right, coming in at stock number 2, though, believe it or not, we have a dividend king that I actually like even more than Pepsi right now. And it's also one of my newest additions to my own portfolio in Stanley Black & Decker, ticker symbol SWK, which currently holds #1 market share for tools and outdoor products in the entire world, operating in 60 different countries with even 90% of all cars and light trucks in Europe and North America using their specific fasteners. And you've probably used one of their tools before too from any number of their popular brands like the namesakes Stanley and Black & Decker, as well as DeWalt, Craftsman, Irwin, and more. Unfortunately, being a global player like this will certainly impact them from higher tariffs. But the good news is that Stanley has at least been proactively restructuring their supply chain for years to mitigate these kind of risks. In fact, they claim that for the past 7 years, the company has significantly reduced their reliance on Chinese manufacturing from 40% down to just 15%, with the CEO saying, quote, we went through tariffs in the first President Trump administration, and we figured out how to navigate it back then. We feel like we are well prepared to mitigate this again. It will create a modest disruption for periods of time in the short term, but a reminder to everybody is that back 7 or 8 years ago, about 40% of what we sold in the US came from China, and now we're down closer to a number that's in the mid-teens, around 15%. And yet, meanwhile, the stock has been absolutely devastated this year, having now lost about 30% of its value year to date and a mind blowing 75% from their previous high. Obviously, there's other issues going on with this company too, primarily a decline in their financials coming off the pandemic highs where sales exploded. But the company should be back to growth in future years as their legacy brands remain some of the most popular in the world, while new investments into smart tools and sustainable products with a focus on new e commerce channels should also help them turn things around over time too. And best of all is that while I wait for some of that to take shape, I get to collect a mouth-watering dividend yielding close to 6%, which has not only been grown for over 5 decades in a row, but it's also among the highest levels that it's ever been, thanks to the stock crash, which also leaves them trading over 50% cheaper than the sector, despite being a market leader. Now, I know they have issues, but at this price, I'm going to be a buyer myself this year. All right, coming in at stock number 3, though, is a king that I just really think is flying under the radar right now, and that is Cisco. Not the tech one, not the technology one, but Cisco SYY, ticker symbol. Now, if you've never heard of them, it's because they're almost like an invisible type of giant within the food world. In fact, they're actually the largest food distributor in the entire US, serving everything from restaurants and hospitals to schools, hotels, and even retirement homes, controlling a massive logistics operation that delivers food and related products to over 700,000 customer locations, which they've been doing for decades. So when you go out to eat, there's actually a very high chance that Cisco handled at least part of what's on your plate before it got to the kitchen. And that massive size has also led to really strong financials, with sales usually breaking new record highs in most years and should even be surpassing 100 billion in a few years too. Unfortunately, as you would expect, the 2020 pandemic was pretty devastating for Cisco, as many of their customers were forced to close down for long periods of time. But even during what was really the worst type of operational environment that you could imagine for them, Cisco still managed to generate positive EPS with surging growth every year since. That resilience has also allowed them to grow their dividends for 56 years in a row, currently yielding close to 3%, with also a very low payout ratio below 50%, meaning it's likely to be very safe here at these levels going forward. As you would expect, though, the Trump tariffs will likely put pressure on Cisco's margins and their overall food supply chain, but over the years, they have at least worked on developing more local and domestic sourcing for that supply chain. And when it's all said and done, I actually think that new trade deals coming in the future could end up benefiting a global player like this longer term. The problem, of course, is that in the short term, there will likely be more pain to come. But while investors wait, they at least get the attractive dividend to collect, with also a stock price that has already been suppressed for years and is currently down 18% from the top, leaving a dirt cheap valuation that is over 20% lower than the sector on a PEG basis, despite this being the clear market leader. I'm waiting to see if I can get that dividend yield up a little higher, though. Usually I want them to be at least above 3%, but the more Cisco falls here, the more tempted I am at starting to buy into a stock like this, which may happen very soon depending on how this year plays out. All right, with that said, we are left now with the final 2 kings of the list. And coming in at number 4, I'm actually going with a pharmaceutical giant, and one of the few that has actually raised their dividend for over 5 decades in a row. And that is Kenvue, ticker symbol KUE, who was actually spun off from Johnson & Johnson, hence why most investors still consider them a king post-spinoff, having kept the company's cash cow consumer health brands like Tylenol, Johnson's, Band-Aid, Listerine, and more that historically were really the biggest reasons for them being able to increase that dividend for so many years. But the great thing about being its own standalone company now is that Kenvue can focus on just streamlining their main operations while also investing in new product launches that specifically fit best with their own portfolio of products, rather than having a giant entity trying to do so many different things at once and getting convoluted and messy. And while this is really by no means a growth-oriented company, that narrowed down focus is at least resulting in record-breaking sales most years. That's the expectation, while the billions in profits is going to allow them to continue growing their dividend that currently sits at not just over 5 decades of growth, but it's actually higher than 6 decades, which is pretty crazy, while also yielding about 3.7% after the stock price fell by double digits since the spinoff, leaving them with also a pretty attractive PEG ratio that is around 50% cheaper than the sector median. I already own several biotechs myself, like in Pfizer, Bristol Myers, Merck, and AbbVie, but Kenvue is definitely high up on my watch list too as a great alternative option to any of those other ones that I really like. All right, finally, guys, for our fifth and final pick, I'm going with the only real estate investment trust that is also considered a dividend king, and that is Federal Realty, ticker symbol FRT, who owns various retail and other mixed-use properties like office and apartment buildings. Now, of course, the majority of their rent is coming from retail, but FRT has actually done a great job of handpicking only the highest quality properties in prime locations across the US. In fact, they prioritize quality over quantity by so much that despite being around for over 6 decades, their portfolio consists of only around 100 select properties, making sure they're located in only the best high traffic areas with large population densities and high average incomes. And because it's been run so well by management during the 2020 pandemic when most REITs were, getting crushed, FRT was actually able to go out and buy new properties to ensure future growth, like in their first assets purchase from Phoenix, Arizona. Now, don't get me wrong, the pandemic was still a difficult time for the company, but sales have been growing every year since, with funds from operations also outperforming their closest peers even during economic downturns. For example, during the '08 financial crisis, FRT put up many times greater performance than their peer average, which you can see on here, it wasn't even close. Now, the result was also that FRT has been able to grow their dividend more consecutive years than literally any other REITs in the entire market, currently sitting at close to 6 decades in a row. Yet because of the cyclicality of these types of REITs, FRT is currently going through one of those major downturns itself, which is arguably one of the best times to be buying this type of stock, as the dividend yield has also risen to one of its highest levels at close to 5%. Like I mentioned in my last video though, I do already own 3 other different REITs myself, so I haven't really been interested in adding a fourth at the moment, so I just think there'd be a little too much exposure to them in my portfolio. However, if I was looking to pick up another, FRT would be right near the top of my list, as I think it's actually a pretty solid choice here at these levels. Anyway, that'll do it for my top 5 list here of Dividend Kings. Let me know if you agree with my list, and if not, what stock would you replace with a different Dividend King? I'd love to hear your suggestions down below in the comment section, but either way, I hope that you enjoyed this video. Thanks again for stopping by, my friends. Thank you for all your support. It means a lot to me. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.